Hello, everybody. Welcome. Happy Friday to you. I hope you had a good week. Welcome to Financial Benchmarking for Success. My name is Nathan Folkler, your friendly representative here at CPA Academy. For those of you joining the webinar through CPA Academy, you can earn up to 1 CPA credit for today's course. Before we begin and get down into it, I want you to check out a couple panes in the GoToWebinar app there on your computer screen. There is the question panel. If you have any technical issues or you have any questions for Roger, please post them there. If you want to right now, let us know how you're doing this Friday. Are you awake? Have you had your coffee? Or are you on the East Coast and it's already noon? Can you hear me? Good? Sounds good? Looks great. Noontime. All right, good. We've got some East Coast people. All right. Thank you. Welcome, welcome. Yes, I've already had 2 espressos this morning. I'm doing very well. All right. Back to the CPE. Remember, there are some poll questions. Roger will prompt those and pop those up on the screen. You'll just need to answer that during the webinar and stay for the full hour presentation. We will issue CPE to you. Usually takes about 24 hours. Just to let you know, FiscalCheckup, they have a lot of webinars, very popular presenter here. I have a couple more webinars coming up. There's Business Valuations, that's coming up July 12th, and then there's Using Analytics coming up on July 14th. Also, I guess back to that GoToWebinar panel, there's a handout there. There is a presentation there if you want to download that. At this point, I'll welcome Roger. Roger, good morning.
Good morning, Nathan. How you doing?
Good, good. Glad to have you here. Take us away.
Great. Thank you very much. So let's get started here. For those of you that showed up on time, thank you very much. This webinar, I don't know how many people here have been on our one or other webinars. We've basically got 3 webinars, as he mentioned. We actually will get into the specifics of that in a bit, but this is kind of the 3rd webinar in the series that really is designed to take a lot of the data that we've generated in the other 2 webinars and actually figure out how to put it to use. So this webinar today is going to focus on what's called benchmarking. We're going to define it, talk about what it is, look at the benefits, and the 6-step process. So let's see here. Click. There we go. Our mission here at Fiscal Advantage is actually to try to assist companies that want to implement change to increase their cash flow and profitability. And we like to team up with strategic business advisors who want to facilitate that change for the businesses that they work with. Our software platform actually is designed to provide a proven process to look at the key financial parameters that are crucial to optimizing business performance. My name is Roger Jacoby. I'm the CEO of Fiscal Advantage. We're the companies that have created the FiscalCheckup software. So let's just talk for a moment about analytics and benchmarking. If you've ever heard the old saying, if you measure it, it gets better, well, in my career, I found this to be very true. But in a business, there are so many different things that you can measure. I've also learned that focus is necessary. You can't set 20 strategic objectives and expect the business is going to be able to accomplish them all. In the end, a good financial, if we look at the financial side, a good financial analytics system in place along with a benchmarking system should be able to identify just the 1 or 2 top areas to focus on improving. In financial, we really don't think you should grab more than 2 in any one year. Then once you've identified what those 2 are, you can set realistic goals, you can develop plans, you can work on improving your business, and we're going to talk today about benchmarking to improve financial performance. But this concept of benchmarking, it applies to almost all areas of the business. So we're going to look at the financial side today, but clearly the concepts of the system can be applied elsewhere. Virtually everything you see in the next hour can be done by hand. In fact, as we're going to talk about industry numbers and things like that, we're even going to, if you want, free on our website, you can get all the raw data you need from your industry so you can do some of your own calculations and analysis for free. We're going to be going and showing some pretty in-depth calculations today. But our belief is that there are software tools that can do the heavy lifting, do the calculations, do the hard part, because we think you should be focusing instead on implementation of the solutions to improve business performance. I'll apologize in advance because there may come a time or two where it's going to sound a little promotional. I'm going to try to save most of the commercial till the end, but clearly, hopefully you'll see today the real value of implementing tools to improve business performance. So let's just quickly go through the agenda. We're going to look at a company's historic performance. We're going to focus on very specific income statement and balance sheet accounts. We're then going to provide just a high-level introduction to the benchmarking process, and then we're going to go in-depth to each of the 6 steps of the process. We're going to look at what we call the gaps between the actual and the ideal performance so that we can choose the best areas to focus on for improvement. And finally, we're going to actually do some forecasting with the numbers to make sure that the goals that we're setting are actually solving the problems that we identified. As Nathan mentioned, this webinar is being recorded. Maybe he didn't mention that, but it is being recorded so that you can review it if you miss a few points. He did mention that there is a PDF copy of the slides over there in the handout section if you're interested. Don't worry if you don't grasp 100% of everything you see. Again, the goal here is actually to expose you to a proven process and a very powerful analytics tool. So at the end of the webinar, I'll spend the last 5 to 7 minutes telling you a little bit more about our company and our software, but let's talk about benchmarking. So the genesis of what we call benchmarking today actually comes from the Japanese. After World War II, the Japanese economy, it laid in ruins, and they had to convert from a wartime economy to a commercial economy. Now the Japanese, they took great care. They went out and they identified the most successful companies in the world and all kinds of different operations, whether they were businesses or governments or builders or manufacturers, whatever. The key was, since they had to start from scratch, Japan only wanted to look at those operations that were at the top of their field, the organizations that had great expertise and a high level of proven results. Well, they then went into those entities and they analyzed the processes of each one of these leading organizations, and they modeled and built their own organizations to match those people that were doing the best. They diligently compared their ongoing operations to these other successful companies in order to be able to find those performance gaps where they existed, and then they wanted a process to change and improve until they reached a high standard of their own. So the Japanese actually brought us what we today call benchmarking. And of course, Japan went from basically total devastation in 1945 or thereabouts to the second largest economy in the world in about 30 years. So as they mentioned, we're going to have some polling questions today. The first polling question is just to find out who is basically here online with us today, what kinds of organizations you represent, whether you may be in the public accounting, private business, etc. And I haven't done it yet, but I will on the other polling questions that we're going to do. I will use that opportunity to look at your questions. So I'll use the polling question time to try to answer questions if you answer them in the questions pane. And we'll get into that as we get to the next polling question. The way this works, if you're not familiar, is we wait till about 90% have voted, or a minute, whichever comes first. And I think, as he mentioned, you need to answer at least 3 of the polling questions and remain logged in for the hour in order to get the credit. All right, we are at 90%, so I'll give the 5, 4, 3, 2, 1. I will close this. I will share this. And it looks like we have a significant majority today online from the public accounting world. And that's cool because you're going to learn, particularly if you've attended the other 2, and we'll recap parts of those today, your businesses, even once you help them identify where they need to improve, they also need help often in how to implement change. And if you look and see what we're doing today, hopefully that you can help get that done. So let me hide this. And let's move on. So when a business looks at their income statement, and here's a sample one here, they can clearly see that the main accounts like, the revenue, gross profit, net profit, et cetera, are all there. But other than seeing the profitability, for most businesses, it's really difficult to know how well the business is doing. And we're going to use the financial statements from this company as we do some analysis today. And likewise with the balance sheet. There's a great deal of information in these financial statements, but the useful information in the knowledge of where we need to focus improvement just doesn't jump out at us. So every company has financial statements, but most companies find it nearly impossible to, what I was kind of describing, to extract what I call actionable data out of their financial statements. And what we're going to talk about today, and you're going to see, is that fiscal analytics, that term, is kind of like the bridge between the financial statements and identifying the actionable data. Now, the two areas that drive profits are cost of goods sold and operating expenses. And the two that drive cash flow are AR and inventory. Now, the first step to establishing benchmarks is to compare the company to itself and to its industry. Now, in and of itself, this analysis doesn't necessarily yet present us with actionable information that can really help the business improve. And as you can see, just even looking at the graphs here, that expenses, operating expenses, and inventory seem to have the most difference between the industry and the company, which is going to likely end up being the best opportunity for improvement, but it really doesn't tell us the value, the monetization, if you will, of improving in these areas. We have to run some calculations to see the value of making improvements. And this is the key to benchmarking, isolating areas for improvement by placing a value on how much the improvements can generate in profits or cash. So benchmarking is a process. It's not a one-time look and see how the numbers compare. What is it? Well, it compares the company to standards. Then it measures the gap for specific areas in order to monetize the value of the improvements. Then it develops a plan to try to close those gaps, and it keeps repeating that process to focus on what's called continuous improvements. Now, what are the standards? Well, comparing to the industry is the most common, but if you think about it, if you have an industry average, by definition, half of the companies should be operating better than the industry average, and half should be operating below the industry average. So sometimes comparing the company to their own best performance is actually better than looking at just the industry averages. Sometimes we need to determine the specific income statement and balance sheet accounts that are most important for any specific business. So what are the benefits? It's kind of obvious, but obviously when companies operate at peak efficiency, you have more money, whether you use that money to expand, reduce liabilities, increase the owner's equity, maybe pay dividends to the shareholders or benefits or bonuses to the employees. But the goal of benchmarking is to promote the most efficient use of time and resources. So the benchmarking process, we're going to get into it. Here's just a quick overview. It has 6 steps. First, we need to gather the data. Then we need to determine the gaps between the company performance and either the industry or the company data. Then we have to actually work with the employees, and we have to communicate with the people responsible that are going to have to actually implement change and get their buy-in. And working with those people, you generally then devise a plan and implement. By definition, you monitor the results, and as the results come in, and you recalibrate to come closer to your goal. The recalibration process is critical. Once you measure your success and you set new goals, and this actually becomes an ongoing process that technically never ends. So based on the new goals, based on the new plans that you have to tweak to get the better performance, then you begin to monitor the new results. Now we're going to begin with that very first step, gathering the needed data, right after our next polling question. And let's see. Talks about where are you coming from today, what role do you have, and let me pop open my questions pane here and see if I can see. Okay, I don't see. Okay, all the questions so far are more related to the what's going on with CPE credit. We have 90% voted, so I'm going to go ahead and give the 5-second countdown of 5, 4, 3, 2, 1. I'm going to close the poll. I'll share the results. Well, I'm going to congratulate 18% of you that actually have a formal program. Congratulations, that's actually a pretty high number from what we've seen before. We do get a lot that say we've set some goals, but the specific plans and processes aren't well known. And clearly we have at least 20% and a bunch of advisors that think that the companies they work with are in desperate need of a system. So let's move forward and let's dive into this and figure out what this is all about. So the first step is in the benchmarking process is to what we call gathered data. Well, what data is needed? Well, from a financial perspective, and again, you can apply this concept to other areas, but in theory, we should focus on the 7 cash drivers of the business. In a perfect world, we would want to have goals or benchmarks at least to be considered for the following 7 accounts. We're going to look at sales, cost of goods sold, operating expenses, accounts receivable, inventory, AP, and even capital expenditures. Now, since sales and capital expenditures are actually more of company goals, we're not going to try to benchmark these in this presentation. And since payables are kind of unique, because if a company pays its bills early and they get a discount, well, that's not really a problem. And if they wait on a little bit and pay a little longer than average, well, then you've added to cash flow. So we're going to concentrate for the next hour or so on the 4 cash drivers that we have the potential to have the greatest influence. So at this point in the presentation, we sometimes get asked questions from businesses that don't have all of these accounts. For example, if you look at our current business that we offer software as a service, well, we don't have inventory, and therefore we don't have cost of goods sold, and most of our purchases are paid online, so we really don't have a whole lot of accounts receivable. So for a company like ours on the income statement, the key account for us to manage is actually payroll. It makes up 75% of our expenses. Now, unfortunately, we've not been able to find industry data that breaks down the operating expenses into their component parts. So what do? We track payroll as a percentage of sales, and we expect it to go down as we grow our business. And we've got a whole bunch of other per employee kinds of metrics that can be used and followed. So each company needs to determine the accounts that are most critical to manage for your business and track them over time. And just because you don't have industry data to compare doesn't mean you can't set benchmarks, set goals, and measure performance. You must benchmark the areas that are important to your business, but for the sake of the process and learning the process here, let's go forward with just these 4 accounts. So the next part of gathering data is to choose the standard. The most common standard, as I kind of mentioned, is the industry average, but one of the issues with any comparison data, including ours, is that we look at one data point for the year when often quarter-to-quarter fluctuations can be significant, and this is especially true of balance sheet accounts. You know, you can't just take the AR days or whatever on December 31st and say that's representative of the entire year. So I'm kind of cautioning you to be very careful in setting benchmarks, particularly for balance sheet accounts, especially if the value at the end of the fiscal year is not representative of the value throughout the year. So consider AR, as I said, on December 31st. So when you look at some of those accounts, it may be better to set a goal to reduce AR by 10%. And then when we look at the average AR each month, and we look at it what it's been historically, we can benchmark off of those numbers. So when we look at industry data, there are certainly some sources online. We actually know some companies that benchmark to a specific public company in their industry. We use a company called RMA for our benchmarking data, our industry data. And RMA is a database of over 260,000 mostly private companies where the data is actually input and it's controlled by the banking industry. As a side note, and I'll cover this at the end, we'll give you free industry comparable data using up to 5 codes if you want. There are some databases available through libraries where you can actually go in and look up data by industry code, but one of the difficulties for many companies has been defining a single code to represent a company. And that's why we let in our software you choose up to 5 codes along with the percentage of revenue from each code, and we use the software to calculate an industry comparable that's a mirror image to the company being analyzed. But remember, as I kind of said, the historic company performance may in fact be more important than the published industry averages, and that the best the company has achieved in their past means they've achieved a standard and are capable of doing so in the future. So let's look first at cost of goods sold. So I'm using the data from the financial statements that you all memorized earlier in the presentation. So again, I'll ask you to just focus on the methodology rather than the specific numbers. When we compare the company's performance to their industry average, there's less than a 1% difference. So when we apply this percentage to the sales, we've monetized the opportunity to reduce cost of goods sold. We also want to compare it to the company's best recent performance, which in this case is not relevant because they're operating today at their best performance. So obviously the opportunity on this side of the ledger is 0. So comparing the company to the industry provides the best opportunity to improve profitability, and we've now quantified that opportunity. We're going to keep track of the opportunities on this scorecard, if you will, so we enter the $97,000 for cost of goods sold here. Just briefly, I just wanted to show you on our cost of goods sold page in what's called our profit driver report, where we look at income statement accounts. In the narrative, we monetize that opportunity that we just talked about, as well as we explain how cost of goods sold affects other income statement sheet accounts. The top graph shows how cost of goods sold impacts the value of the company, and because of the latest year had the lowest cost of goods sold, there's no improvement in company value. The bottom line, the bottom graph where it says CGS as a percentage of sales, it's really hard to tell because the company's in green, the company's in red, but as you can see, they're tracking very closely together. So let's now look at operating expenses. When we compare to the industry average, there's a much larger difference than what we just had in the cost of goods sold example a minute ago. And when we apply that percentage to sales, we've monetized the opportunity. We also want to look at the company and its own recent best performance, and applying that percentage to sales, we've monetized the goal to match the company's recent best performance. So when we compare two sides here, we can see comparing the company to the industry, in this case, provides the best opportunity to improve profitability, and what we did here is quantify that capability. So going back to our scorecard, we're going to add the operating expense opportunity for savings, and from the profit potential side, we now have identified over $483,000. And again, just briefly looking at our page dedicated to operating expenses, in the narrative we explain it and we quantify it. We explain also how it would impact company valuation. And one of the interesting things that we often calculate is how much profit or how much sales would have to increase to cover the inflated operating expenses. Some companies believe they can simply solve all their problems by growing the revenue, and that's rarely the case. Finally, we've graphed the company data, in this case in blue, and the industry data in red. You can clearly see that the company trend is clearly going in the wrong direction. It's moving farther and farther away from the industry numbers. So before I move on to AR and inventory, we often get asked, are the industry goals in this case realistic? Well, there's often two camps. One says, let's just make small increments for improvement, and as we achieve those, we're going to update the goal. And the problem with the approach is listed here, but one of the real problems is never letting the employees know what the real goal is. So the other approach says, let's set the goal, let's set the benchmark at the standard we want to do it. Let's set the standards, let's keep at it, and since benchmarking is about a process, setting the one clear target at the end and continually recalibrating or adjusting the plan in order to achieve the target, for most companies provides the best approach. And the reason is it changes the discussion from why does the goal keep changing? Just because we achieve the goal, they keep changing the goalposts on us. Instead, the conversation, well, what other changes do we need to implement to achieve the goal? And normally simpler is best, and we believe letting everybody know right up front what is the real goal is the best way to do it. So now let's move on to the accounts receivable opportunity. This one mathematically is a little more challenging. It's not as straightforward as the income statement, so see if you can stick with me here. We start with the industry receivable days that we get from the industry report. We look at the best the company's done from the financial report. In this case, it was 2 years ago. We also need the company's latest receivables and their latest sales. And we need to actually calculate what's called receivables turnover. We can't monetize it until we have the ability to look at the receivables turnover and determine what it should be. So here are the industry, the turnover for both the industry and the company, and I'm going to bring these forward to the next slide, but whereas the other one was just calculating a number and applying it to sales, this is a two-step process. We need to calculate turns first, and now we're going to be able to monetize it because now we can show here's the industry data for the AR days and the industry turns. Then when we divide the sales by the industry turns, we get what should be the accounts receivable balance. Well, when we look at our current AR balance, we can see the opportunity when comparing the company to the industry. Now on the right side of the ledger, when we look at the company and the best they did 2 years ago, we can again calculate, based on the turns, what should be our target AR balance. When looking at the current AR balance, we can see the opportunity when comparing the company to their own recent best performance. Obviously, we're going to choose the higher of the two. So on our scorecard, we enter the $64,000 on receivables. Looking again briefly at our report, we explain the opportunity in plain English, as well as the benefits of reducing a lower AR, and finally you can graphically see the company and the industry trends. So let's look at inventory, and it's almost the same calculation as we just did for AR. We get to the inventory days from the inventory report, industry report. We look at the best the company's done from their financial reports, which again was 2 years ago. We also need the company's latest inventory and cost of goods sold. And first we calculate the inventory turnover for the current company here, and we also look at the best the company's done in the industry. So you can clearly see we calculated all of the industry turns numbers for all of the parameters we need. We're going to pull these numbers to the next screen, and we now have the data that we need to monetize the inventory opportunity. So first, again, here we show the industry data, and we divide the cost of goods sold by the industry turns, and we get the target inventory balance. When we look at the current inventory, we can see the opportunity by comparing the company's current balance to what it should be if we were matching the industry standard. When we look at the best the company did 2 years ago, we can calculate the target inventory balance, Again, looking at the same current inventory, we can see the opportunity comparing the company to itself. Again, we choose the higher of the two to set our goal for inventory. Back to our scorecard, we enter the potential cash savings if we could be monitoring or managing ourselves at the inventory level of our industry, which brings our total cash savings to $929,000. And I realize you really can't add these all up, but we're going to do it for the sake of argument here, of over $1.4 million in potential opportunities to improve financial performance. Now, in this example, the industry comparison was always higher. That is rarely the case. If the company is performing above the industry average in any of these, then comparing the company to itself would provide the greatest opportunity for savings. So here's the inventory report. It clearly documents the opportunity and monetizes it. It describes some of the benefits. And again, here we can see graphically, look at that green line. It's way, way above the industry average in inventory days. So you can clearly see why the opportunity, when we monetized it, was so significant. So these numbers are not uncommon for companies with 10 to 15 million in revenue, but if your company is larger or smaller, focus instead on the percentage profit increase and the percentage increase in cash, because for any company, improving profits by 3.5 basis points and cash by 20% of the assets is pretty substantial. So we've now ready for our next polling question. And if you look at all of the different areas of a company, which do you think has the greatest need or opportunity for improvement? And let me see if I can view any questions. See what's coming recently. Are the turns calculated on an annual basis, or they can be done on a monthly basis or a rolling 12-month basis? Again, if you've got the numbers, the problem is the industry numbers. One of the issues is the industry numbers are only published on an annual basis. So that is pretty much that why we do this on an annual basis. But when you, as I said earlier, once you identify particular opportunities in, let's just say this is inventory days for this company, then, or the inventory level, then setting a goal to reduce inventory by 10% or something like that and applying that data throughout the year is probably a more realistic way to approach this. So I'm going to have to close this because we're at our 90% and I want to keep moving. If there's time at the end, I'll go back and see if there's other questions. So I will close this. I will share the results. And what's interesting here is the winner in every webinar we've done this year, with the exception of one, forecasting and planning is the greatest need that companies have. We're going to actually cover forecasting and planning with these numbers later on in this presentation. But clearly, both operating expenses and cash management are very close, right behind them. Most people don't believe they need a lot of help in cost of goods sold and capital spending. So let's move on. We've spent a considerable amount of time on the first two steps of the benchmarking process, but setting the specific monetary goals is the foundation to the entire process. This is the part where the analytics tool can actually provide the numbers and do a lot of the calculations forward. So the next step is to communicate. Step 3. Now, when speaking to the management staff, show them how the numbers were calculated. Explain the implications to the future of the company. And eventually, all employees that are going to be involved are going to need to be educated. And to the extent you need to, you may need to educate some people. And the key point to drive home here is the need to improve cash flow and profitability. Now, in my experience, it's amazing how often when you go and actually explain to the people what the issues are, it's amazing how often the employees know ways to fix the problem, but nobody's ever asked them, and even if they did, they don't feel like they got listened to. So it's the numbers that should be discussed for improvement, and employees see how far behind they are behind their industry. They should be able to understand that they have to do things to help bring it into alignment. Clearly, in this case, the operating expenses and the inventory have the most potential for improvement, and so we're going to focus on 1.2 million here in this example, and as we discussed earlier, focusing on only 2 objectives is much easier than 4, and it's the numbers that we should be able to communicate and get people to buy in. And clearly, my experience is putting financial incentive to the employees that have to come up with the plans and implement does great things to get them excited about solving the problems. So the key in this step is getting their buy-in. And it's amazing how often one of the key buy-ins we have to think through is senior management. Having them imagine, first of all, how much easier it would be to manage the company with an infusion of cash, and when looking at profits, if it's irrelevant to them, explaining how that affects company value can also be important. Some opportunities, though, clearly we need to understand might require involvement with an external expert, such as the CPA. For example, if inventory is one of the targets for improvement, clearly, whether it's raw materials, work in process, finished goods, obsolete inventory, shrinkage, or if a new inventory management system is justified, that might be best accomplished with an outside expert. FiscalCheckup does the diagnosis to identify the problem, but it's up to the business owner working with the CPA to engage outside experts to understand the root causes and the solutions sometimes. Sometimes employees are very helpful. Sometimes you need an outside expert. And that's another point here. We've worked with some CPA firms that were afraid they were getting in over their heads because they didn't have somebody who was an expert, in this case in inventory. Well, clearly what the business needed from them was someone to be the catalyst for change, not necessarily an expert that knew everything about everything. You can still be the facilitator or the catalyst for change without being the expert in everything that's needed. So the next step, the 4th step in the process, is to actually sit down and devise and hammer out plans to how you're going to accomplish the goals. And it's much better to start with focus, as we've talked about, in the 2 areas in this case. So as we've seen for this company, the 2 are the opportunities. Here are operating expenses and inventory. And once you've chosen those primary areas of initial focus, it's time now to sit down with the people in the company who have the responsibility in those areas that are targeted and determine if it's something we can fix internally or we need external help. Work with them, whoever them is, to devise a written, documented plan, and it'll be your knowledge of the company's accounting methods with the people with the knowledge of the business or the process that really will result in a plan that has a chance to work. Clearly, you need to get consensus in order to get buy-in. You also need to convince the people that the goals are realistic and that you have a measurement system so they'll know when the goals have been achieved. Well, depending on the plan, you may need to bring in wider audiences in order to get the company behind achieving the plan. And helping management empower employees is often one of the keys to success. The next step is monitoring. The plan should include how and when the results will be tracked. Regular reviews of the progress and the deviations. Report back to the committee or whoever has been assigned what's working and, almost more importantly, what's not working. The key is a well-documented plan where all policies and procedures, as well as the goals and the measurements, are all spelled out. No plan is perfect the first time, so clearly as you gain experience, it's likely you're going to need to recalibrate, have to decide what's relevant. Maybe there's some things you have to push to the side. Again, that word communication is there. Communication to everybody involved is key, and you have to be prepared to be flexible. you're going to have to change the parts of the plan that aren't working. Long-term, benchmarking is a process that should never end. It's always looking for ways to improve. Now, it may be difficult to change the culture if that is what is required. Often one of the big resistances is we've always done it this way. Well, that has to be kind of thrown out if we're going to make the changes that make improvements. So once you tweak the plan in the recalibration step, you might need to set new goals and even monitor the results, and how you monitor it might change in the revised plan. In reality, you go back to the beginning of this entire process and begin collecting data for the company at the beginning of every year, because you have to see the shifts, either the progress the company's made or the changes in the industry. You may have heard the old adage, and I said it earlier, if you measure it, it gets better. But in order to get better, you need to optimize the cost structure and the cash management practices of the businesses. By using the scarce resources efficiently, your company will be around to compete in the future. You can help your company improve profitability and cash flow. Time for polling question number 4 here. Find it. There it is. This one, we've kind of covered the 6 steps. We've grouped 1 and 2 together because gathering and measuring the data is basically part of the same step. So we're just wondering, out of the 6 steps, which you think is going to be the most difficult. Let me see here. Polling question, I can't answer that one. Jake asks, once you've identified the key difference between company standards and the company's performance, how do we help them fix the problems? Well, that's actually, as I said, the role of the CPA, if that's what you are, Jake, is to be the facilitator, the leader, the catalyst. You will be shocked how many times the people in the company, in the trenches, the staff line employees, once you've explained what the problem is and what the goal needs to be, you'll be shocked on how often they know how to fix the problem. But if they don't, that's where you then need to help identify an industry expert to be able to come along and help them. So let me close this poll and share the results. It's interesting through the steps 1 and 2, 27, we can see the numbers there. Actually, I think you're probably right in that the third step, or phase 4, devise and implement, is going to be, because writing a good plan, including goals and monitoring steps, is the most difficult part. But again, if you've got the right team of people, it is definitely a doable step. So let's keep moving on here. So based on the current trends of the company, here's just looking at, if we continue what they're doing, here's their 3-year forecast. Now we're going to change a few variables, and I want you to focus on line 7, 14, 17, and 27. We're going to look at those lines here as we move forward. Based on our previous analyses, we're only going to change variables for operating expenses and inventory. We're going to look at changing the future forecast of the company. We're going to look at 2 scenarios. In one scenario, we're going to evaluate just achieving the company's recent best performance, which was operating expenses as a percentage of sales of 26.93, and it was inventory days of 88.25. In our software, you can change those 7 areas, but we've only focused on operating expenses and, we're focused on cost of goods sold and inventory, so we're only going to make changes in those 2 accounts. The second scenario we want to look at is that we want to evaluate is if we achieve the industry comparable levels for operating expenses as a percentage of sales of 26% and inventory days of 59. Now, I fully realize decreasing inventory days from 88 to 59 is not likely to occur overnight, but the purpose here is to show you the impact of just making changes in these 2 accounts on the financial performance, and I'm not going to make any changes in the other areas. First, I want to look at EBITDA. Now, the improvement in EBITDA, if the company could just achieve their own recent best performance, is actually 33% or over $200,000. But if they could attain the performance level, if they could bring these two accounts within the rest of their industry, EBITDA would improve by 56% or over $350,000. Moving on to cash after operations, based on the recent trends, the company isn't cash flowing, and over time, as you can see, it's not getting better. I would hope you'd want to know this. Now, if they could just achieve their own recent best performance, that middle line there, they would at least cash flow at this level a $464,000 improvement. And cash flow looks like it's stabilized by the second and the third year. And if they could achieve the industry average, then the cash flow problems would be solved. Realize that the significant improvement here is due to reducing inventory by 29 days, a one-time significant impact on the balance sheet. That's why that 2016 number is so huge. Unfortunately, after we include capital expenditures and financing costs, the numbers get worse. The improvements in cash flow are the same as the previous screen, but as you can see, unless the company intends on borrowing more cash, it's going to need to achieve a level better than their own recent best performance. Because of the positive EBITDA, at least their debt service coverage ratio is above the minimum 1.25 to get financing. But if the company could just go back to their own recent best performance, the debt service coverage ratio would improve by 1/3, and if they achieve the industry average, it would improve by more than 50%. So in summary, if you don't measure it, it's not going to get better by itself. Benchmarking is a methodology that defines and identifies the most appropriate targets. It develops plans to achieve the targets, and it measures against the targets. Once you've identified the most appropriate targets, forecasting lets you evaluate the impact of the changes and determine if they're sufficient to achieve the company goals. Now for the next 5 minutes, since we're near the end, in case you've not seen it before, I'm sorry if you have, we're going to just take the next 5 minutes or less and tell you a little bit about FiscalCheckup software. We start with some survey results. And if you work with small to medium-sized businesses, particularly if you're a CPA firm, have you ever wondered what other services beyond tax and compliance? In a recent survey of small and medium-sized businesses, 55% said improving financial performance was their top priority. Almost half wanted external help to accomplish their goals. 44% said their current firm had low or no impact on their business performance. And for me, surprisingly, only 12% plan to seek a new accounting firm. So FiscalCheckup is an online software tool. It was developed to assist companies that want to implement change to optimize their financial performance. We work with and want to empower the business advisors with all the information they need to help their clients succeed. Our goal here is to provide a proven process, a financial roadmap, if you will, for companies that want to thrive. It's a 3-step process. The first phase where we spend the majority of time in our analytics webinar, and we've spent a lot of time today, FiscalCheckup conducts a deep assessment into all of the variables here and identifies the best areas for cash flow and profit improvement. Once we get some specific recommendations and we identify those, the software also monetizes the precise profit, cash flow, and business value that can be generated from implementing the improvements. In the market valuation phase or the business valuation phase, FiscalCheckup uses traditional valuation approaches. We want to calculate the fair market value of the business, and this is critical so we can measure future improvements against today's value. We have a dedicated hour-long webinar on our business valuation tool. The third phase of our software or our process forecasts, like we've just done, the business's financial performance over the next 3 years assuming their trends continue. And as you saw, we allow you to modify up to 7 variables to see how they're going to impact future earnings, cash flow, and even the value of the business. And again, we saw a brief introduction into that capability today. Our 3-phase process is designed to empower the business advisor to help their clients thrive. Setting up a benchmarking program would actually kind of be phase 4 if we added it to this flow chart. So a complete fiscal checkup consists of 6 different reports. The executive summary contains the overall summary, including our specific recommendations where we've identified the top 2 or 3 recommendations for the company for improvement, as well as the forecasting tool. But in addition, there's a profit driver report that does a deep dive on the income statement accounts. The cash driver report looks at the balance sheet accounts. There's a complete business valuation. We have a lender's report, which really helps the company see how the lenders view them, and even an industry comparables report, which looks at the company on 54 different ratios. So Fiscal Checkup is affordable. It's only $495 per year per company being analyzed. We do have discounts and subscription models for the advisory firms that'll do more than 10 a year. So if your firm wants to grow your advisory service revenue by knowing exactly where your business clients need your help, if you want to improve your business client retention and even maybe grow the number of your business clients, then I think you'll see that Fiscal Checkup is a solution made for you. At no charge, we have 2 free reports. You can create a free Fiscal Checkup report card on any business. It's pretty easy. It takes less than 5 minutes. It only requires 3 line items from the balance sheet and 4 from the income statement, plus the relevant industry codes. Here's the second free report that I mentioned earlier that's available. This is where you can give us up to 5 industry codes, the percentage of revenue, and we'll create a industry comparable report, 54 variables on exactly a mirror image of the company, and this is provided at no cost. So let me get to the polling question here that asks about what are going to be your takeaways from this webinar. And let me pop up the questions pane here. Does your software import from QuickBooks and import-export to Excel? Great question, Brian. We do have an interface from both QuickBooks Online and QuickBooks Desktop, and we even have our own custom Excel spreadsheet so you can work completely offline, fill in the spreadsheet, and import either of those in with the click of a mouse. It says, here's Jennifer asks, if we have our own benchmarks, can we use them for comparison? There's no way to put those into the software today. It's an interesting question. I think you would want to compare your own benchmarks with what we're doing here. We are working on the next version of our software where you'll be able to actually put in data and we'll actually be able to look at things more on a quarterly basis than more of the annual basis that we're doing here. I see another question here. If we're not a CPA, can we come in as a profit and change person to help the company? There's a trust factor to develop, though. Absolutely. I mean, anybody can. I don't want to say anybody can be, let me rephrase that. If you're qualified to be a business advisor, we work with a lot of consultants and consulting companies who provide advisory services. I didn't mean to state that this was only for CPAs. We also have a lot of companies that run this analysis on their own. Sometimes they do get involved with their CPA to attend. So let me close this poll. Let me share the results. Oh, great. We got a bunch of you that want to attend either our business evaluation or our analytics. And it's okay, there's 32% of you that want none of the above. I have 2 more slides. I'm going to quickly go to this one. I'll come back to this one in a minute. Now my last polling question asks if you, and I'll go back to the questions tab here in just a second, but the last one asks if there's any follow-up you want from us. And I want to oops, I got to hide that. I want to mention that because actually there's some of you that in fact are here just for the education and you would prefer not to have us, even though we send out educational emails, would prefer not to have us fill your email boxes. So we even give you the ability in number 1 here to asked to be removed from our email list, and I'm okay with that. If you want a printed copy, it's over 40 pages long, so make sure if you ask for the printed copy that you're going to use it. I'm okay with sending it to you. Some of you, and we've had a number this week, want a personal phone call. So let me put the questions back up on my screen here and see if there's other ones here I can answer. Do you have any materials, information on marketing this type of services? Yeah, Jake, yes we do. We've got a 2-page flyer that's designed for the business advisor to give to the client. When I get done with this poll, if you want to send, or I'll have your email address. This question will be documented. I'll send you a copy of that. So how do we access the free reports? If you go to our website, FiscalCheckup.com, in the top you have to create a free account, and then when you click on the button that says I want to create a report, it gives you a choice between an industry comparable report, the industry comparable report with the report card, those are both free, or the fully paid report. Let's see, are there other questions I can have here? I can scroll back here. All I see is they're now allowing me to make selections. We're having problems with polling questions. It says just because the industry average is higher, that doesn't mean a specific company should match. For instance, if they make a higher quality of product, you'd expect cost of goods sold to be higher, wouldn't you? Thanks, Jake. I would agree with that question exactly. All we can provide is the data, and that's where the business advisor needs to come alongside and clearly determine the relevancy. In a case like that, comparing the company to their own industry trends over time might, in fact, be more appropriate. So I'm going to go ahead and close this poll and share the results. I'm just going to hide that so that you can now see my email address here if there's anything specifically you want to question me for. Just looking at more questions that are here. Another one from Jake, the cash potential doesn't translate directly to profit. Oh, absolutely. There's the profit, obviously, I know, comes from the income statement, but cash is often needed to grow profits. So how are we reconciling that figure with the actual earnings? Well, we've looked at profitability from the income statement separately. Those were the first two accounts we analyzed from the cash flow. Now in the forecast, certainly sales and reduced expenses, whether they be cost of goods sold or operating expenses, those do flow through as less expenses, so that does improve cash flow. In fact, one of the reasons we have the simple one-page forecasting, because a lot of people have difficulty understanding how cash flows from the income statement, assuming you've got profitable sales, into the balance sheet and impacts the cash flow and the financial and cash position of the company. That's why we have that. In fact, on that same sheet, it then takes and works you through the bankability all the way to the very bottom line, which talks about the business value. So completely agree with you there. Thank you, Roger. I have another webinar. You're welcome. There we go. Can I get the report, Derek? I'll send it to you. Hopefully you filled it out. And you're there. I think we're all done. We got 2 minutes to spare, and like magic, someone from CPA Academy is going to come back online.
Here I am. Thank you so much, Roger. Thanks for another great presentation. Hope you have a good weekend. Thank you to our audience, too, for participating. Thanks, Roger. Thanks for participating as well. Thanks for all the questions. As you know, and as you got through that last poll, as long as you answered those polled questions, or as many as you could, you'll be issued CPE. We'll get that process for you by Monday, so you can check your accounts by Monday. If there's any issues, you can, of course, reach out to us through cpaacademy.org. And I want to remind everybody that along with these live webinars, we also do self-study. So if you go to cpaacademy.org, you'll also see a self-study tab. You can do things on your own time. We'll be adding more and more selections to that list. That is all. If you have another webinar, you probably should go jump on it right now. Otherwise, have a great weekend. Thanks so much.